Hello, everyone. Thank you again for joining us for this month's live market update. My name's John Pasalis from Realosophy Realty. My team and I help buyers, sellers throughout the Toronto area make better real estate decisions. As always, if you have any specific questions, you can send me an email at askjohn@movesmartly.com. We should have a link to meet with me in the show notes below. But as always, every month, these are live discussions because we want everyone to be able to post their comments in the chat. So if you have any questions about what is going on in the market, please post them in the chat. Urmi Desai is from Move Smartly is on the discussion here. So she'll be kind of keeping an eye on all of the comments that are coming in. So please feel free to share those. As always, every month, I'm going to kind of give a quick overview of the market for houses versus condos, looking at some historical trends. What does this month's, or in this case, we're going to look at August, the data. What do the stats for August look like compared to historical months? We're going to chat a little bit about what Gus and Davin from my office are seeing on the ground, what we are seeing as we move into the fall market. The fall market is usually the second busiest season of the year, spring being the busiest. September is usually when buyers jump back in. So what are we seeing? What are the trends? We're going to chat a little bit about that. And as always, we have David Larock, mortgage broker, contributor weekly to our blog Move Smartly, who's going to be chatting not just about interest rates, I should update the slide, but a broader macro outlook and some of the things that we should be keeping an eye on going ahead. So we're going to kind of just kick things off by looking at the latest stats for the low-rise market. So that's for houses. When we look at the volume of sales in August, I mean, specifically if we look at detached homes, which is sort of the dominant type of housing for low-rise homes, we had 2,200 sales, which is practically flat compared to last year. We're down a little bit, but that's pretty much the lowest volume level I'd say like on record since like going back to 96 or very close to that. For sure, lowest volume in 20 years. The average, the more typical 10-year average volume of sales for the month of August is usually around 3,500. We're at 2,200. So very, very weak sales volume. And again, the dynamics here are really just high prices, high interest rates are making housing unaffordable, combined with a lot of buyers just hitting pause, waiting for rates to drop a little bit more, to make buying a little bit more affordable. So soft sales volumes for houses. When we look at the listings volume, about 5,500 new listings, up slightly over last year, a little bit below the 10-year average. Typically, we're closer to 5,800 new listings. And when we look at the active listings, they're up quite a bit over last year, 9,600 active listings for sale. That's up 40% from last year, where there was about 6,900. And that is above the 10-year average, which is just over 7,000 new listings. So quite a few properties on the market. And again, I think when we think about active listings, I talked about this in last month's episode. Active listings is a function of two things: how many new listings are hitting the market and how many sales are happening each month. So when new listings are somewhat average, which is what we've been seeing, the surge in active listings is not about everyone rushing to sell. The surge in active listings is really just driven by the very, very soft sales volume, which we discussed is at 20-year lows. So when we have sales volumes at 20-year lows and new listings that are kind of typical, what happens is active listings build up. Fewer homes sell every month, and we see a buildup in inventory. And when we think about inventory, we talk about this each month. We often look at this, what we call the months of inventory, which is the relationship between the total number of active listings on the market divided by the number of sales. And it kind of gives us an idea of how long it would take the current inventory to sell. So the higher the months of inventory, the slower and the softer the market. And then the lower the months of inventory, the more competitive it is. And, if we look at that for all low-rise homes, we're about 4 months of inventory. And that's up from last year. Last year was a relatively sluggish market. Last year at this time, we're under 3 months of inventory. So again, the market is a little bit slower this year than what it was last year. And again, I think part of that is just people seeing that rates might drop, kind of sitting on the sidelines a little bit. So again, 4 months of inventory, pretty soft market. And what that looks like on the ground, the big difference between 4 months of inventory and 2 months of inventory is more homes are sitting in the market longer. Fewer homes have offer nights. Some do, of course. Some do sell with bidding wars, usually the nicest ones. But just more homes sitting in the market a little bit longer. So we're seeing that even in the low rise market for houses, that they're just a little bit less competition. And even when homes have multiple offers, they're not getting 20 offers. You're getting 1, 2, 3, 4 offers. A lot less competition. So definitely a more sluggish market as we ended this summer. We're going to obviously we're going to talk about and look at what is happening as we're moving into the fall, because the summer statistics can sometimes be a little bit misleading. Active listings numbers can sometimes be lower than what they should because a lot of people just cancel the listings at the end of the summer. So we have to take some of this with a grain of salt. But again, it's still high volumes, even if we had a lot of people canceling their listings, if that makes sense. When we look at average prices for low-rise homes, we are still at about 1.3 million, which is down 1% over last year. We've dipped a little bit month over month since peaking a few months ago, but seasonally we're basically down just 1% over last year. Now, looking at the condominium market, trends are slightly different. I mean, condos had about 1,400 sales, condo apartments last month. It's down about 11% over last year, but a fair bit like below the sort of the average was around 2,000 units or 2,100 units. But so softer sales, but not quite as soft as what we're seeing in low rise. Low rise certainly is seeing kind of softer volumes relative to historical trends. When we look at the number of new listings in the condo market, new listings are pretty much flat over last year, just under 4,000, above the average of about 3,500. But again, part of that average of the 3,500 was influenced by this huge spike over the past 10 years, like the 10-year average is 3,500, but we saw a huge spike in 2020 due to COVID. But certainly we're, among the highest. Second, probably this, aside from that spike in 2020 in August, this is the second highest volume of new listings hitting the market for condominiums for the month of August. And again, part of that is we've seen record completions and we're seeing more investors exit the market. So the combination of strong active or new listings, because this is relatively strong for the month of August, combined with softer sales, is leading to a very, very high volume of active listings, over 8,000, up 52% over last year, and well above the 10-year average, about 4,700 units that are active typically for the month of August. So we're seeing a ton of inventory. And again, when we look at the news, you look at the headlines are often about the surge in condo listings and this, oversupply, condos sitting in the market. And when we look at the months of inventory, it's largely flat month over month, about 5.7, 5.8 months of inventory. Last year, 3.4 months of inventory. So again, we're softer this year compared to last year. And then average prices are just under 700,000, 694, which is down 6% over last year. And I mentioned in my market update, which we published, I think, yesterday or the day before, that, I think this 6% decline is noteworthy. I mean, the past few months, we've seen about 4 months of year-over-year declines, but they're for the most part like 1% or 2%. This is the first month where we've seen a slightly more meaningful year-over-year dip in prices. It's going to be important to see, of course, if this is just driven by some outliers and is skewed by a few statistics, or if this is in fact a trend where prices are gradually grinding down a little bit for the condo market. We'll see a little bit more clearly once we have the September data. And we'll wrap up by looking at, I mean, I typically kind of look at the weekly months of inventory because it gives us a more real-time look. So this is just months of inventory calculated weekly by looking at the previous 30 days sales and the current active listings. Again, as we move to August, the data kind of is a little bit misleading, but again, it's generally relatively steady over the past few weeks. Over 6 months of inventory actually for condominiums, and over 4 months of inventory for low rise. So what can we expect kind of this fall? You know, I figure before I kind of jump into it with my own thoughts, maybe we'll bring on kind of Gus and Davin, hear a little bit about some of the things that they're seeing, and have a little bit of a chat about kind of the trends they're seeing on the ground. I'll unpack what I'm seeing on the ground and kind of we'll go from there. So guys, thanks again for joining this month.
For sure. Thank you.
Thank you.
Yeah, Gus, I mean, why don't you kind of kick off some of the things that you've been seeing and kind of keeping an eye on as we're moving to the fall market?
Yeah. So, I mean, generally speaking, August is a pretty sluggish month. You know, thinking back to last year, it was really quiet. There wasn't a lot going on. A lot of people on vacation. The market was moving very, very slow. This year seemed a little bit different. Yes, the market's slow. Yes, sales are low, are very low, but it felt like people were trying to be somewhat active. Obviously, there were more listings, so people getting out there and still listing in August. But also, especially the last couple of weeks of August, noticed an uptick in interested buyers and some competition for some houses. It's really neighborhood driven. It's really product driven. It's you know, I haven't seen this separation. I don't know, in the almost 9 years I've been doing this, I really haven't seen it where it's so separated. Usually when the market's busy, it's still maybe not as busy in the upper northern neighborhoods or eastern or western neighborhoods. But, you know, if you see bidding wars, you kind of see them across the board for the most part. Not now. It's really odd. You're seeing some neighborhoods where homes are really sitting. Some decent homes are sitting and not really getting a lot of attention. And then you're seeing these really sought after neighborhoods, great schools, transit, excellent walkability, a little bit more known and older neighborhoods, something like you know, Broadview North, where Withrow Park is, or maybe something near High Park, or neighborhoods such as those. Seton Village has been one that a client of mine has just recently bought in August, and we were tracking. And it's funny. I mean, these are small neighborhoods; they're not big, so fine. Neighborhood is because the neighborhood is small. You're not seeing a ton of inventory, but there's a ton of people looking at these neighborhoods, even when it's quiet out. Seton Village is a perfect example. Maybe 4 homes came up from May till August that matched their criteria in that 1-2 range, and they all pretty much got multiple offers, with the exception of one, which still sold within a week. And by the way, it was on probate, meaning the buyer couldn't get access to it till late November because they had to transfer the home to the next of kin, to the children. It was an estate sale. And so they bought it all the way in June, understanding they're not going to move it in November, and they rushed to give them full list price. So we're seeing those things happen in those high sought after neighborhoods. And then, you know, I'm also seeing obviously the really nice renovated, well done homes that are in that 1.5 range doing well. There was one recently at Withrow Park that got 20 offers. It was a fixer upper semi. Yeah. And wow. She got 20 offers. So, but that's not normal. It's not. No. I'm not saying bidding wars are back. I'm not saying it's crazy out there. It's just, there you go. Like, it's right by Withrow Park. There's not a lot of inventory there. It was priced low at $1 million. It sold at 1.5, which I had pegged it closer to 1.4. But they got 20 offers. So you're still getting that. And then the other trend I'm seeing is first-time home buyers coming in. I've noticed quite a few myself, a few other agents that I've been talking to. First-time home buyers seem to be waking up. whereas a few months ago there wasn't that many out there, obviously for affordability reasons. But yeah, I have a few clients looking at 1+1 condos or 2-bedroom condos, and especially now that they see the news that prices are a little softer in condos.
Yeah, that's super helpful, Gus. And you're right. I'm finding that as well. The market's all over the place. Yeah, some places you'll see homes selling super quickly. Some seemingly super nice homes just sitting on the market. Homes that would have gotten multiple offers even 3-4 months ago are just sitting. So it's difficult to navigate. We've talked about this timing, buying and selling. It's very, very hard to predict when we're thinking about that. So, Davin, what are kind of some of the things that you're kind of seeing as well on the ground?
Yeah, obviously similar to Gus, since we operate in the same markets, but just to kind of build on that, I'm finding it's really, really driven by school district, and that's what we're seeing. Like that 120 offers, that was the only game in town for sub 175 in that school district.
Mm-hmm.
So I mean, of course, everyone who's just chomping at the bit to get into those specific schools, they're gonna do their best to kind of gather that home. And that home, yeah, I had it pegged at 1.4, and like it was a gut. The whole thing needed a renovation, tip to tail. So yeah, like I said, same as Gus, like people kind of waking up, buyers and sellers, most of them wanting to do both. And the conversation is obviously always the logistics of sell first, buy first. And of course, I have people now who are doing a condo to condo transaction. So that's going to be very interesting because, in that instance, what do you do really? I mean, obviously, yeah, you sell first, but let's say you're on the market 2-3 weeks, you get an offer and you're like, okay, if I accept this offer, now I got to buy. Let's take a beat and look at what's out there to buy. Oh shoot, there's nothing to buy.
Mm-hmm.
So like, what's the cost of letting an offer go versus like the inconvenience cost of not getting your landing point in like the 6 to 8, 9 weeks before you close.
Yeah.
So like, are you willing to rent for 6 months while you poke around for the right place to land? So it's tricky when you're moving from one product and then going to another product that is just kind of slow or not really existing at the plane that you want.
Yeah, that's a very good point. And I think that as you say that, I mean, it had me thinking. I didn't think about it earlier when I was talking about the stats. I actually think that's really a big factor of kind of what's behind the soft sales we're seeing. If you think about it, and you tell me how many clients do you guys have who, and I have the same, who kind of feel stuck because they want to upsize, but they're anxious about buying first because they're not sure if their home's going to sell quickly. On the flip side, they don't know if they want to sell first because they don't know how long it's going to take them to buy. And they don't want to move into a rental. They're thinking, well, maybe the market's going to be busier in the spring anyway. So I'm selling in a slow market, buying in a hot market. That's not great. So there's a lot of people I feel at least who feel kind of stuck. And I don't know, Are you guys seeing that? I've heard that a lot from clients who just aren't sure even how to proceed.
Yeah, it really depends on what they're in. Obviously, a first-time home buyer wouldn't have this problem. That's the ideal right now in this market. But it's the ones who are living in homes that just, to be quite objective, are not going to fly off the shelf, right? If you do have ones that are just objectively very, very good, they have confidence going forward. They can buy first, but the majority, that's just not the case. So that is what I'm seeing for sure.
Yeah.
There's quite a few that I have that are in that predicament. And I recently helped a couple buy sell clients in the spring, and they did it where they bought first and then sold, but that was in April and May and still relatively busy first half of June. So I don't know if they purposely timed it, but they timed it. They got it right. And now I have friends of those clients who are trying to do the same, and they're finding it difficult. And we have to have the conversation of, well, market's a lot different today than it was, even 3-4 months ago. Like you mentioned, I recommend you sell first because it's sluggish, and you may not be able to get what you want, and you need to take that money. You need to sell to get that money to be able to close on the other one. Don't get yourself into trouble. So yeah, seeing that a lot with and even people that I met with last year that I'm still communicating with that seem to be a little bit confused as to how to proceed and which to do first, and they're just watching. So I think that just goes to say there's a lot of people on the sidelines just watching and waiting. And I don't know, does that signal that come spring, if rates are, I've been talking to mortgage brokers recently where they're like 3.99 is coming, it's coming, 3.99. And so does that mean come spring, if we have rates in the threes and inventory is still decent, maybe these people are more confident to jump in. I don't know.
Yeah, and I think one thing I'll add is that, like sales are still happening. I mean, Gus, you guys listed a condo in Leslieville. I think it's sold in a week with 2 offers, which
sold conditional in a week with 2 offers. Yeah.
Right. Yeah, I know. I mean, I think Anastasia had a listing downtown at City Place. It's sold pretty quickly. So, there are still buyers. Obviously, transactions are still happening. It just takes longer. And I think this is the challenge with a lot of owners, that we're not used to a market where it takes months to sell a property. Even though that's quite normal in a lot of other cities, we're not used to it in Toronto. And I think a lot of people are struggling to adjust because they're used to prices selling in a week or 2 weeks or a month at most. And I think the market's slowly adjusting to that. So we'll see how things unfold. Urmi, I don't know if we have any questions from anyone in the chat.
Hi, everyone. Yes, we have an interesting question. I think it boils down to this idea of paying a premium. I'm going to share it in 2 parts. So Thomas asks, how much more valuable is a detached versus a semi versus a condo townhouse in a city like Toronto? In this market, is it worth the difference in cost?
Oh, that's such a hard question. I don't even know how to answer that because I mean, like, look, if you want just a simple answer, you can just look at the Toronto Real Estate Board data for the city of Toronto and look at average prices. But it's very hard to compare because, again, like, part of the price difference is you're getting usually completely different properties. I mean, the detached homes usually going to be bigger, might have private driveway, like they're completely different properties. So yeah, I mean, you're paying for, in some cases hundreds of thousands of dollars more for a detached home. In some cases the premium's not that big if the detached homes aren't as big in that area. So it's very hard to just put a number on it. And I think
sometimes you get a semi that's like $2 million, and the detached might be much smaller and be in
it's true.
1.5. Right?
Yeah, it's 100%. You're 100% correct. In some cases, the detached might be less expensive, but again, that's just reflected in the quality and the size. So the best thing, coming back to the question if it's worth it, I mean, the best thing that you want to do, and we do with our clients, is we kind of kick off our search with our buyers with what we call like a market education tour. And the whole point is to go through this exercise. It's like we're looking at 3 or 4 detached homes in particular neighborhoods, 3 or 4 semis in a few different neighborhoods, because you can't do it without seeing it. You have to see what you're getting at what price and what area to help zero in on what you value more. Because at the end of the day, you're either paying a premium for a similar sized home because it's detached, and you have to do that math to see if it's worth it for you. Or you're paying, in Gus's case, the same price or less, but the detached is smaller. So I think it's important to kind of do that analysis to kind of figure out what's worth it for the individual. There's no right or wrong. I mean, some people would pay a premium for detached, some people won't, because they value, for the same money, they'd rather be in a better location. If that makes sense.
And overall, John, there's a sentiment that, Toronto just doesn't have a lot of detached homes, and that's finite. To what degree does that kind of thinking lend itself to thinking, you thinking, well, it's always worth to bid as much as you can for a detached? Like, at what point does that sort of thinking, maybe run you into trouble?
I mean, there's of course a lot of truth. We're not building a lot of low-rise homes generally. We're certainly not building many detached homes. So yeah, I mean, long term from an investment perspective, yeah, probably a detached home is going to outperform a condominium, for example, right? But I don't know if you stretch your budget and pay anything just because it's a detached home. Like at the end of the day, you got to live there for 10 or 15 years. It has to fit your lifestyle. It has to fit your budget. You don't want to be house poor, and I think the better way to think about it is if you have a certain budget and you prioritize that idea, like the asset value, the long-term growth, more than say location, because this is a typical trade-off. If we control for the size and condition of a home, for example, well, if you're getting detached, you're going a little bit further, for example, from the subway, a longer walk, right? You're a little bit further out versus if you get a semi, you're right by the subway and close to shops, right? So again, it's all about the individual. If you prioritize the land value and all of those things, you move further away and you buy the detached. If not, like I don't know if I would, even though I agree with that premise, right? Even though I agree with this idea that detached is great because the land value is going to be strong, appreciate in the future, especially as we can upzone in Toronto. I don't know if I'd make that trade-off because I also like walking to my coffee shop. You know what I mean? And I'm going to be doing that for the next 10 years. So I don't think there's a right or wrong. I think it's just personal preference and lifestyle.
Thanks. And that leads us to part 2 of Thomas's question. Same, I guess, question. What factor is it that causes real estate in the GTA to be priced similar to Toronto in this market? So I think even briefly during the COVID period, we saw a bit of this dynamic. How are things at now? I mean, usually we would expect Toronto to have a bit of a premium attached.
Mm-hmm. Do you guys want to?
Well, it's not really apples to apples when you're making those comparisons, right? So if you're talking $1.75 million in Toronto, you get one product. If you're talking 1.75 million in Oakville, it's a very different product. It's still expensive, but it's very, very different. So I mean, to make these comparisons on price when it's not like apples to apples, it is kind of tough. I will say, we saw obviously things were, probably overpaid for, pretty significantly in the outer GTA during sort of the COVID spike. But those have come down, and they're probably going to continue to come down for the most part. Like a detached in Bradford is just not going to be $2 million anymore, right? It's not even going to be close. But I think if you take like a 30-foot lot detached in Toronto, it's going to be very expensive. That same thing is going to be, much cheaper in like Oakville, Burlington, Mississauga on a 30-foot lot, 3-bed home. So it's not comparable per se, to be honest.
I think lot is a big deal. I've had a lot of clients ask and look specifically for larger lots and still are. And so I think you can't get a 50 by 150 in Leslieville. It's just almost impossible to find, right? But if you go to if you go just to, I don't know, maybe just north of Lawrence or closer to Shepherd, or even if you go to Scarborough, or even if you go Richmond Hill, you can find that, and you can definitely find it in Oakville, unless it's a newer build, of course, because they're making the lots smaller. But you can definitely find it in those other outer areas, and yeah, you might pay 1.5 there for a 50 by 150, but you'll pay 1.5 for a semi that's, like John said, is walkable. So I guess it depends how much land and space you want on the outer part of your home if you don't want your neighbors close to you. Does that make sense? I don't know. I find 100%. People value that extent. Yeah.
It sounds like there's some real estate buyers or to-be buyers who seem to they don't really care what they're buying. And it's going to matter once you start living there, right? You got to like where you're actually living. So I think that's a big thing to take into consideration. Like, yeah, sure, it is an asset class, a house to a degree, but at the same time, it's going to be a huge part of your lifestyle. So, that's a huge consideration. Like, if it's detached, condo, townhouse, semis, like all these things at the same price are going to afford you super different lifestyles. And if you don't jive with all three, well, you're going to have to kind of put yourself in one that makes sense for you.
Thank you. We have another question here from Vitz Finath about the reduction in immigrants and the number of students. Will it have some impact? So, John, I think you've recently written on this, the federal government changing, capping and cutting some of the student visa numbers, and now they're looking at temporary workers.
Yeah, so that's so for those who aren't familiar, the federal government was planning on reducing the number of international student visas issued by 35% this year compared to last year. That number is closer to 45%, it looks like. And again, part of this is because, I mean, this has been a big driver of the boom in Canada's population, just these colleges admitting so many people. You know, and a lot of it is just criticism that, you know, recruiters were misleading students into believing that this is a sure path to permanent residency, kind of pushing them into these dodgy colleges. I mean, and that's not even my interpretation. I mean, our own immigration minister, I can't remember what he called them, puppy mills, or like just bad actors, you know, just these terrible institutions. So they're trying to kind of clamp down on that. In the process, student numbers are down. And if you look at the trends, I mean, I tweeted the other day a Globe and Mail article that in many of these college towns, rents are down a little bit. There's more availability. Places are sitting on the market longer. You know, a lot of investors who bought homes and converted them to these illegal rooming houses for international students are having a hard time renting them now because there's just not as many international students. So it's certainly taking pressure off rent growth. It's going to make those investors maybe consider selling in some of those markets, but I don't think it's like causing the housing markets to cool down dramatically. Again, these were international students who are renting room. Like it's not like it's not like impacting the downtown condo market, right? These are usually in smaller towns, outskirts. So certainly, I think the one side effect is you might see some investors just decide to sell their houses if they were using them as rooming houses. I don't know if that's going to be big enough to kind of cool prices, but we should definitely obviously want to keep an eye on those trends.
Great. Sticking with the rental, unless Gus, Davin, you wanted to add anything you've seen in particular on that trend?
No.
Let's stick with the rental question from Riaz. This is very interesting. This is a longer comment, but as a real estate investor, I currently own 6 properties in the dynamic GTA, and 4 of them predate November 2018. While I've built solid equity in these units, I'm constrained by the 2.5 rent control increase imposed by regulations. So that date is important because we know that the provincial government rolled back and said, okay, all buildings built from this date onwards are not subject to that rent control. These buildings are. Riaz is wondering if in the next few years, they should transition to buying new units that would not be under rent control. And sort of, you know, moving the money into those units and away from these older units. Very interesting question.
It's a good question. I mean, I'll answer this perhaps with some bias. I'm not an unbiased commentator. I mean, I think there's 2 issues here. Number one, those new units are ridiculously expensive, like far more expensive. You know, if you look at the relationship between what you'd be paying for those new units and the rent, your return is likely going to be better on your existing product, is generally my experience, is number one. Number two, I think I talked about this on a previous show. Many, like at least today, we're seeing on the ground a lot of tenants negotiating rent caps when they're buying in those buildings because they know there's no rent control on them, but because there's a decent amount of inventory, investors want to rent them, they're agreeing to basically the provincial rent cap even on new units, right? So there's no guarantee you're going to get out of that. But, you know, again, at the end of the day, you know, if you're an investor, I'm an investor, you have a rental property, you're getting your income, you're going up 2.5% per year. Yes, you're not like squeezing out every ounce of the gain. You can only kind of increase it when your unit turns over. I mean, it's not the end of the world. I don't know if I'm going to go out and sell everything to try to maximize that, but that's just my approach. I mean, I'm kind of, you know, I don't feel like I need to do that.
Also, I mean, this is a guess. I don't have any insider information, but I'm pretty confident it's going to happen. They're going to change those rules. It's not going to be, you know, the rent control is going to change. You know, whether it's in 2 years or 10 years, that's going to change, and it's not going to be, you know, there's too many new builds coming up, I think, and it doesn't make sense that they wouldn't change it eventually. So I don't know if that's the strategy to go by. Never mind the costs to sell your current units and incur costs to buy. units. If you take all of those costs into consideration, the gains you make are probably going to be erased. And the fact, like you said, they're more expensive. So,
and rents right now they're on the flat line / going down. So I mean, there's some kind of ceiling at some point, right?
Yeah.
So if you think you're gonna increase your rent above and beyond the 2.5, 2.1, whatever it is year to year, the market may not want your 5-10% increase. It probably won't absorb it. So I mean, then your whole transaction, all this rigmarole of getting new units is moot, and you're just in the hole and you're gonna be kicking yourself. The best thing is to not sell real estate. So don't sell it and put it in something more expensive. Just keep cash flowing where you're at. And those people who are in those units, they will move it on their own accord, and then you can reset the rent at the market rate, and that's going to be your best bet.
Yeah, to your comment, Devin, even if you can raise the rent 5%, I've heard of many people and many landlords say to me, well, I tried to raise it 5% or 8%, and they're moving out because there's lots of choice. So they'll just find a cheaper unit to move
across the street. Get something else.
Why are they going to accept that 8% or 5% increase? They're just going to go to a different unit. They're not that tied to it, especially when there's 7 other units available for lease in the building nowadays.
Yeah, just go up 2 floors.
Yeah, I mean, and that probably that gives rise also the savviness of what John was saying of people actually negotiating in newer builds to just have that cap. And Gus raises a great point. Gus, you're right in saying that the provincial government under the Wynne government had a rent control applying to all buildings. That was rolled back by the Ford government. And so that was then that November date became very important. But who knows in the future?
I mean, Ford's probably not going to change that, but if we have a shift in government to liberals, very possible. I agree. But guys, I'm going to thank you for your time. I realize we're approaching 22 and we're going to bring Mr. Larock on to chat a little bit about macro, but thank you so much, guys, for your time and everyone for your questions so far.
Cheers.
Let's have Mr. Mortgage Broker Extraordinaire, David Larock. Thank you again for joining us. A lot of things going on in the economy, in the world of interest rates. Of course, the Bank of Canada cut. What are some of the things that you saw from their announcement that kind of stood out when we're thinking about what to expect in the months ahead?
Well, the biggest takeaway from the bank's announcement is they've dropped all pretense that they won't keep cutting. They've basically acknowledged that their main concerns now are downside risks to the economy. Aside from the unavoidable caveat that if inflation turns the other way, they reserve the right not to keep cutting. They've effectively said they're focused on downside risks. They even said if we need to cut by more, we will. So right now we've had 3 quarter-point cuts, but at the press conference, somebody asked if they would consider a 0.5% cut. My last blog post before the Bank of Canada's announcement said they should cut by 0.5 point. Basically, I made the argument that even though they're cutting now, the policy rate is still putting brakes on the economy. It's still exerting a tightening impact that we no longer need. And that will be the case until the policy rate drops to between 2.5% and 3%. It's down from 5, but it's still at 4.25. And at 4.25, it is still significantly slowing the economy. And my argument is we don't need the economy to slow anymore. We need neutral right now is the least the bank should be doing. If we get a recession, they'll have to go below neutral and try to stimulate growth. So to me, quarter-point cuts, even if we keep getting them at every meeting, and that is, by the way, what the bond market is pricing in. The bond market thinks the BOC, right now, the bond market is pricing in, the futures market is pricing in 1.25% more cuts by the BOC by June of next year. And that would get us down to 3%. I think that's conservative. I think we're going to probably 2.5%. And if we get a recession, below 2.5%, because the BOC won't be stimulating the economy unless we go below that level. And they've been below neutral in every past recession. Interestingly, John, inflation's now 2.5%, but the biggest single factor contributing to inflation pressures is mortgage interest costs. And if we back out mortgage interest costs, which are a direct result of BOC monetary policy, our inflation would be about 1.2 to 1.3% right now. So we're already way below target, but for mortgage interest costs. And as I've mentioned in conversations we've had in the past, most developed economies don't include mortgage interest costs in their tracking of inflation data and in their consumer price indexes for that reason, because mortgage interest costs are directly tied to Bank of Canada monetary policy. But the good news is, if they want to lower inflation, all they have to do is keep cutting now, because if those mortgage interest costs come down, so too will overall inflation.
That's a good point. Now, I mean, not to get too wonky, you raise a good point about mortgage interest costs, but I was actually speaking with an economist recently at the bank. You know, the one challenge with that argument, I feel, is that the countries that don't use mortgage interest use the rental equivalents, meaning there has to be some way of factoring in housing costs, right? So
Yep.
You're either basically saying, I'm going to calculate what are the costs to own as a homeowner, rent, so on and so forth. All of those kind of costs as a homeowner. We're not going to look at the obviously the asset as an appreciating asset, but what are the costs to own versus sort of the US, who does a rental equivalent. And I believe that even if we didn't include mortgage interest, if we used a rental equivalence approach, I don't think we'd be much different. Like, in fact, we'd probably be the same. And I think that's the challenge with the idea that it's driven by interest rates, because even if we change that methodology and use, a rental equivalence like a lot of other countries do, shelter inflation would be pretty similar, right? But I take to your point. I mean, I think, as the bank with Canada's method, as Bank of Canada cuts rates, that's actually going to lower inflation because interest rates are part of that calculation. So I think that is a valid kind of criticism.
I take your point, John, but just to throw some numbers at you, in August, our shelter costs increased by 6%, our rents increased by 8%, and mortgage interest costs increased by 21%. So I agree that we would still be seeing inflation pressure from shelter prices if we measured it differently. But when I look at shelter prices on a subcomponent level, mortgage interest costs are more than 3 times hotter than rents or overall shelter costs. So I think they would still be significantly driving inflation, but maybe not to the extent that they are when mortgage interest costs are a large contributor to the overall CPI. And by the way, back in May, the weighting for mortgage interest costs in the CPI actually was increased. So we've doubled down on the impact that mortgage interest costs are having on our overall CPI. And at a time where the bank is determining how rapidly it's going to cut rates by what that CPI number says, I think it's certainly important to highlight that about half of that 2.5% inflation rate that we're seeing today, which is dictating the pace at which the Bank of Canada cuts, about half of that overall is coming from those mortgage interest costs.
That's super fair. Now, what are we seeing? I mean, a big component, of course, of what the bank's going to be doing are labor markets. And what are we seeing on that front, kind of based on the latest data? And how do you think that might influence their next move?
Well, this is really interesting. We've seen a slowdown in hiring, first of all. We had no net new jobs in June and July. In August, we got 20,000 new jobs. The public sector is about 1/4 the size of the private sector, and the vast majority of hiring in the last 12 months has been in the public sector. So it is not a healthy sign for our economy that most of the hiring that we are getting is public sector hiring, not private sector hiring. That certainly isn't a healthy signal for overall employment. But most interestingly, John, average wages have been a real thorn in the side of the BOC for some time now. They've clipped along at about 5% for well over a year. And the BOC has repeatedly said that if with productivity falling and average wage growth at 5%, what that means is it's becoming more expensive to maintain the same output. And that's inflationary. And they've been very concerned about average wages for some time. Average wages have fallen for the last 3 months. They went from 5.4 to 5.2 to 5%. But not to get too wonky on you here, they're guaranteed to fall by a lot the next time we get our employment report. And the reason why is average wages are calculated looking back over the most recent 12 months. And 12 months ago, last September, we had a huge increase in average wages. So next month, when we look at the September data, that huge month from last year falls off and is replaced by a more normal month. And that's going to significantly impact the overall average wage growth number, and it's going to come way down from 5%. I don't think the market has fully priced this in, but given that that's one of the last remaining inflationary concerns that the BOC has, these base effects, they're called, are going to lead to a much slower average wage growth number going forward. And we could easily be in the next few months down to about 3.5% for average wage growth. And if we continue at current trend levels, we could be as low as average wage growth of 2% by next January. I did a post on this. I modeled out based on, I took away the months that are going to fall off in the coming months as the 12-month rolling average goes by. And I added in more months at how we're trending today. And basically that sharp drop in average wage growth is already baked in, basically, unless there's a real sharp rebound in hiring, which just isn't evident, at least to me at this point, and it's not showing up in any of the data. So average wage growth is going to slow significantly. That's coming up. Hiring is already slowed. We haven't seen a ton of layoffs yet. That would be the next phase. And unfortunately, while I'm not rooting for that to happen, I think that will happen. That'll be when we get in, when the word recession starts coming up a lot more in the papers and in the analysis done by economists. It'll be because those layoffs are increasing. And layoffs, when we look at mortgage defaults and arrears, higher interest rates don't have much impact, not the impact you would think on people being able to make their mortgage payments. Example, they went down when mortgage rates tripled. We've come off the COVID lows. Mortgage rates went up to the high 5, low 6% range. Arrears actually went down over that period. The job losses are directly tied to mortgage repayment and would lead to a spike in arrears. And if we get a spike in mortgage arrears, that'd be bad for the housing market, and it would certainly cause lenders to be. It would reduce their appetite, and it would change the market. So, as you and I have said several times over the past few months, we've warned people. Yes, we think rates are going down, but no, we don't think that means house prices are going to go ballistic. And don't expect that will happen. Quick sidebar. I tried to look back and say, why do people think when rates fall, prices are going to go up? And it's very understandable. The last 2 times rates fell by a lot were 2008. We had the U.S. housing crisis, the U.S. financial crisis. Our mortgage rates were dragged down because U.S. rates plummeted, but the Canadian economy was robust and stayed strong, and our housing markets were resilient. So house prices went up. So interest rates went down by a lot in 2008. They were pulled down by what was happening in the U.S., and our house prices went way up. The next time rates dropped by a lot was during COVID. Again, house prices went way up. The economy was not impacted. Our central bankers thought we were going to get a depression, and that's why they cranked rates down, and both fixed and variable rates fell through the floor. But we didn't get the economic shock they thought we'd get. The economy remained robust. So while it has been true in the living memory of a lot of people looking to buy houses today, or even who've owned houses the last 5 or 10 years, while it's been true that lower rates have led to higher prices in the past, it's certainly not a guarantee it'll happen this time around. And as you and I have both said, we don't think that will be the case, and that might help explain why people make that assumption.
That's a great point, David. I'm going to bring Urmi on because we got about 10 minutes left just to see if we have any kind of questions for David.
Great. Hi, David.
Hi, Urmi.
Question, building on something you were talking about in terms of what might be next for the economy. You talked about the prospect of layoffs. Our question from James is whether you're hearing about people being nervous. Hi, team. Are you seeing a lot of people hesitant to enter the market due to a lack of job security? I'm looking to buy, but am worried about losing my job in the near, not too distant future. Thanks.
Well, the 2 things I would point to, the Bank of Canada does consumer and business surveys, and in their Q2 surveys, consumers were more worried about job loss than they'd been in the past, but businesses were saying they were going to slow hiring, but they were not as yet anticipating layoffs in general. That's not every business, but that's on an aggregate basis. So I would say thus far, it's worrying consumers more than it's in the plans of businesses. But let's face it, if the economy slows and businesses have to cut costs, labor will be impacted.
Yeah, and I think just to add on that, I mean, I think it's very fair to be concerned. I mean, as a buyer, I mean, you have two major risks. Number one is you buy a house and you know, you happen to lose your job before you take possession. I mean, that's a terrible situation to be in because it's gonna, I mean, correct me if I'm wrong, David, they might not get a mortgage. Like they're not gonna issue a mortgage if things have changed in your employment between when you bought and when you close.
Yeah.
So you could lose your deposit. So all sorts of obviously things can happen in that period. And then, of course, once you take possession of the home, you of course have a mortgage payment that you need to maintain. And you're right, there is the risk of, you know, what happens if someone loses their jobs. I mean, if I was in that situation, I mean, I'm highly risk averse. Like I'd have to probably have enough cash saved up to like pay my mortgage for like a year and a half from savings. You know what I mean? Because you don't know how long it's going to take you to find another job, especially in a slowing market. So yeah, I think people need to, I think it's fair to be kind of cautious and mindful of that.
Thank you. And another question, maybe it's the last one. It's a classic.
Mm-hmm.
Hi, David. If I were to buy a home, is it better to go with a 3-year fixed, or do you have a better idea?
Well, if you read my blog, my Monday morning interest rate updates, which are on my site and are also available on Move Smartly each week, at the bottom of the blog, there is typically a section called Mortgage Selection Advice. And in it, I offer my best guess at what the future holds, my crystal ball being as murky as ever. And I always say, my opinion in $2 will only ever for sure get you a hot cup of coffee. But if you read the last 20 some odd posts, you would find my advice has been very consistent. When I look towards my view of what the future has in store, I think the odds heavily favor variable mortgage rates to save money over fixed rates, even though variable mortgage rates today start out at a premium of about 0.75% to 1% above today's 3-year fixed rate options. I would be deciding between the 5-year variable and the 3-year fixed. Wouldn't go longer than 3 years on the fixed because I think it's reasonable to believe rates will be lower in 3 years, materially so. But again, some people just like stability and they're taking 5-year fixed. But the vast majority of the folks I'm working with are deciding between a 5-year variable and a 3-year fixed. I think the 5-year variable will save you money. I think the odds certainly favor that based on where we are in the current rate cycle. But obviously, that's not a guarantee. And I think a 3-year fixed is a good option. And I would be deciding between those two. But in answer to the question, gun to my head, I think variable rates will prove cheaper. That is my assessment currently.
And just to unpack that a little bit, you know, to give some people some numbers. So, David, I think you mentioned that the 3-year fixed is 0.75% or 1% higher than the variable. Is that right?
Yeah.
Okay.
Yeah.
So, and you also said between now and June, the markets are pricing in that the Bank of Canada is going to cut by 1.25%, right?
Yes.
Which means, in theory, by June, your variable rate's actually going to be lower than your fixed rate, right? And I think this is kind of David's point. So you're paying a slightly higher rate for, you know, 9 months or whatever it is, but after that, for the remaining whatever it is, 2-3 years, you're actually going to be lower than the 3-year fixed. And I think this is kind of where David's coming from, and I don't disagree with it. I mean, I think that's a very reasonable argument. But again, it comes to risk tolerance. A lot of times, you know, I think that's kind of one of the key considerations. Some people just like the certainty and not having to worry about it. Some people will take the gamble.
Yeah, John, let me, if I could just qualify a couple other ways. If you're a first-time home buyer taking on home ownership costs for the first time, I think you lean towards fixed rates in that case, not because you think they'll prove cheaper, but because there's a lot of value that comes with the stability of a fixed payment when you're getting used to home ownership. Mm-hmm. There are a lot of surprise costs. You don't call the landlord anymore when something breaks. You got to go down to Home Depot and buy yourself a new one. The other thing is you got to be able to sleep at night. And I've had borrowers who took variable and ended up saving money, but wish they'd gone fixed because they worried too much about it. You got to know yourself. Absolutely. Conversely, if you can tolerate a little more risk, variable rates are convertible to fixed at any time. Fixed are not convertible to variable, and variable rates also come with lower penalties to break in the vast majority of cases. So there are pluses and minuses of both. And I think if you're deciding on a mortgage, whoever's advising you on that, the mortgage advisor or the mortgage broker that you're speaking to, this is part of the conversation you should be having with them. Again, they don't know the right answer. You've got to figure that out for yourself, but they should be able to lay out the trade-offs so that you can make an informed decision.
And this
Great.
is why David Larock is an excellent mortgage advisor, because
Yes.
he lays out the trade-offs for you. And everyone's getting it on our show today. So thank you, David.
Thanks, John.
Urmi, anything else? Or we're going to wrap up?
I think we can wrap up.
Awesome. Thank you again, David. Thank you again for joining us. It's always a pleasure. Thank you all for your questions, for your discussion and your comments. And we'll see everybody next month.